historically, if you get a 50 basis point rise in unemployment, it normally leads to a recession. It doesn't just stop there. You don't just kind of go back up 50 basis points and then kind of normalize flat. Usually unemployment
Mhm.
keeps going up, and that's by all accounts a recession. And so of course in a recession, normally you do get Fed easing. Now it doesn't necessarily happen right away. It's not like as soon as you cross 50 basis points, you're in a recession right away. The Fed's cutting right away. But it's just historically that move has not happened without that over the coming quarters continuing into a recession. Now, I was hesitant to say at this time that some of those rules like that are potentially a little looser in this environment because we've never had a kind of this divergence between fiscal policy and monetary policy before.
U.S. Federal Reserve members plan to maintain elevated interest rates for an extended period, as indicated in the minutes released on Tuesday from the central bank's meeting held between October 31st and November 1st. The Federal Open Market Committee participants assessed that the current restrictive monetary policy and the ongoing normalization of aggregate supply conditions are contributing to a more balanced alignment of aggregate demand and supply. According to the minutes, the Fed aims to increase rates by 525 basis points from March 2022 to July 2023 over 11 meetings, responding to heightened inflation that reached its highest point in over 40 years during the previous summer. Despite this intention, the bank chose to forego an interest rate hike for the third time on November 1st, maintaining the federal funds rate within the 5.25% to 5.5% target range, the highest in 22 years. Lyn Alden provides insightful analysis of the macroeconomic outlook, particularly in relation to the Federal Reserve and its policies.
Please take a moment to like this video, subscribe to the channel, and don't forget to drop your comment and observations in the comment section below. Thanks and enjoy the video.
So in general, the Treasury tries to maintain a pretty kind of static ratio between T-bill issuance and longer duration bond issuance. And the problem now is that they're releasing more into the market than normal. The deficits are unusually large, especially outside of a recession or other kind of crisis event. And so there's just kind of like this ongoing quarter by quarter deluge of supply. And the Fed's also doing quantitative tightening. So they are, they're selling through maturity. They're letting bonds mature off their balance sheet and not reinvesting those proceeds, which is effectively a sale. Because the dollar index is strong, there's not a lot of foreign demand at the moment. That's unintuitive to people, but basically when the dollar is strong, usually the foreign sector is not really buying a lot of treasuries. They're often more in currency defense mode. And if anything, they're either selling reserve assets or they're more often just holding flat. Whereas when the dollar's weaker, they're more likely to be in reserve accumulation mode. And so they're not really on average buying at the current time. And then also banks are, kind of carefully managing their duration. And for the first time in a long time, they had an absolute drop in the number of treasuries they were holding. And so with all of these buyers off the table and how much supply is coming, that means basically all of it has to be absorbed by the domestic non-bank sector. So insurance companies, pensions, asset managers, households, hedge funds, and these are entities that generally don't have all this extra leverage. For example, the banking system has leverage, the Fed has leverage, but these are less flexible balance sheets to absorb all of this. And one of the remaining pools of capital, pools of liquidity available, is the reverse repo facility. That you can kind of consider that like a spillover for like excess demand for T-bills specifically, not for longer duration, just kind of T-bills, like cash equivalents with no counterparty risk. I mean, your counterparty is the Fed. And so money markets could easily replace some of their reverse repo exposure with more T-bill exposure. So right now, there's at least $1 trillion worth of T-bill exposure that could rapidly be consumed by the market. Which is not always the case, but that's the case right now. Whereas there's clearly a more limited demand for longer duration, like T-notes, T-bonds. And so rather than just the Treasury kind of keeping with their normal cadence and their normal split of how they're doing things, they've been very aggressive on the T-bill side, which is interesting for a couple of reasons. One, it's the more expensive part of the curve. So the Treasury has to optimize for a couple things. One of them is trying to minimize expense for the government. And yet we have an inverted yield curve and they're still issuing on excess amounts on the short end. But number two, they're also doing that to not hurt liquidity. They don't want to draw, value out of bank reserves. They'd rather kind of pull from this reverse repo facility. And so basically, it was like a bigger than normal jump for what the Treasury would do. I think it's one of those things like it's just a not something that most people follow. The quarterly refunding of treasuries is it's usually a boring thing. But this was probably the first time where a treasury refunding announcement probably moved markets more than an FOMC announcement from the Fed, just because there was kind of more of interest there. And in some ways, the Treasury has been affecting liquidity conditions as much or more than the Fed lately. And so these two forces have been kind of at odds. And so it's interesting that there's another variable there that can, surprise us one way or another quarter by quarter.
Inflation, which had been on the rise, exhibited a slowdown, with consumer prices showing no increase on a month-to-month basis in October. Although the Federal Reserve has not officially declared a combat against rapid price increases, the prevailing sentiment in discussions has been shifting towards deliberating on how long to maintain the policy rate within the current range of 5.25% to 5.5%. The most recent policy meeting, in contrast, revealed that all participants deem it appropriate to uphold the existing rate setting. This stance will be further elucidated during the Federal Reserve's meeting on December 12th to 13th, where policymakers are set to release a new set of detailed projections for interest rates and the overall economy.
And so the challenge is that as you get higher and higher public debt, interest rates become a less effective tool for slowing down the economy because, if you have low debt and a lot of bank lending and you raise rates a lot, you slow down bank lending more than you blow out your deficit. A little bit of both happens, but the lever is bigger on the reduction of private credit. Whereas if you have like average or sluggish bank lending and you have very large public debts, and you dramatically raise interest rates, you do, slow down bank lending, which wasn't that significant to begin with. But then you also are now pouring out very large deficits into the economy, and someone's on the receiving side of those deficits. And while they might not have a velocity of stimulus checks, they have a non-zero propensity to spend. Some of that money is just, if you give a billionaire more money, they're probably not going to go spend it. But if you give a lot of upper middle class retirees more interest expense from their money markets, and they've got a locked in fixed rate mortgage, higher interest rates basically stimulate them. It gives them more spending power. And that's one example of many. But basically, when you look at all this interest expense from the US federal government, there are entities on the receiving side of that, and some of them do spend. In these past 18 months or so, we are growing pretty slowly, and even for a period of time we're reducing, not really anymore, but for a period of time you're reducing, and that's because the Fed's QT, especially when they basically are affecting non-banks, that can reduce the money supply around the margins, and so there was some destruction of money, and also they did slow down the rate of bank loan creation. So we kind of flatlined in terms of U.S. aggregate bank loan creation. So you kind of either destroyed money or slowed down money with those levers, while the fiscal side was still adding to money. So I think temporarily, you can pretty much do anything temporarily. So had this 40% surge in money supply, and then since then they've been kind of trying to get it back down to the prior trend line. I think basically once we get to that point we talked about before, where the reverse repo facility runs out, once they go back to a period of gradual balance sheet expansion, I think that's when you have a period of kind of money supply reaccelerate back towards or slightly above its normal baseline trend. And I've also been looking at another metric, which is similar to M2, but basically I look at bank deposits plus currency in circulation plus money markets, which is a similar but slightly different metric. And you'll generally see that has not slowed down to the degree that M2 has. Because for all intents and purposes, people treat their money markets like cash, even though it can consist of T-bills and commercial papers and reverse repo and all these kind of wonky things. It's, for all intents and purposes, money. A T-bill is in many ways money, even though it's debt. Because even a dollar bill is a liability of the Fed. It's a type of debt in a sense. But basically, T-bills are money-like in a closer proximity than, say, stocks or long duration bonds are. And so things like money markets or the assets inside of money markets can be very money-like. And so in that sense, money supply is still growing pretty substantially. If you get a lot of T-bill issuance and a lot of money market usage, the overall kind of quote unquote real M2 is actually probably a little bit higher than what we see looking at the official M2 metric. And so while you can slow down it for a period of time, I do think it's likely to accelerate. And like you said, you generally want to keep up with broad money supply, or different metrics of broad money supply, or at the very least keep up on a per capita basis. So if money supply is growing by 7% a year, population is growing by 1% a year, you should at least be trying to keep up by 6% per year.
The U.S. economy recently recorded a robust 4.9% annualized growth in the third quarter, indicating a potential inflationary trend. However, rising interest rates in financial markets pose a threat to economic and job growth, surpassing what might be necessary to achieve the Federal Reserve's 2% inflation target. Participants in the Federal Open Market Committee noted a significant tightening in financial conditions due to higher long-term yields, yet inflation remains persistently above the central bank's target. The FOMC minutes conveyed a cautiously hawkish tone, emphasizing a commitment to a prolonged restrictive stance until sustainable downward movement in inflation is observed. Fed Chair Jerome Powell, in a recent press conference, carefully navigated the delicate balance between addressing elevated inflation and anticipating an economic slowdown. Despite positive indicators, including a Fed staff study suggesting delayed rate increases allowed for more economic growth without sacrificing progress on inflation, policymakers remain cautious. Powell stressed a readiness to tighten policy further if necessary, highlighting the importance of a careful approach to avoid being misled by short-term data fluctuations and the risk of over-tightening. Looking ahead, uncertainties persist regarding the U.S. economy's outlook. The question remains whether the economy will rebound as feared, especially in the context of ongoing inflation challenges. Comments and insights on the U.S. economic outlook are welcome in the comments section below. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.